As a trader, have you ever entered into a position only for you to get immediately stopped out by a few points and then have price reverse straight towards your original target? If this is the case, chances are you haven't been using this one trading rule that changes everything. This one rule that I'm about to share with you is one of the most powerful rules that will increase your win rate instantly. So with this being said, I'm going to share with you exactly how to implement this concept, and then I'm going to be sharing with you some real examples to help you guys become profitable traders. Let's get into it. So you might be asking, what is this rule and how is it going to increase your win rate significantly? And this is what's called the 84% rule. You might have heard me talk about this plenty of times, and we're going to do a deep dive into exactly what this 84% rule is, how to trade this, what entry criteria to look for, when you should take the 84% rule, when you should not take the 84% rule, how to manage your trade when you do take the 84% rule, just overall everything that you need to know about the 84% rule. And then of course, we're going to go on to some live examples as well. So with this being said, when it comes to trading, what is the most frustrating part about trading? And the most frustrating part when it comes to trading is getting stopped out before it works. So what you can see here on the left hand side is what we have is a clean break and retest of a key level. You can see price breaks below, we come back for the retest. You can see we have a nice little reaction here as well. This is where we look to get in with a stop just a break above, and what we're looking for is continuation towards the downside. But you can see in this case, price immediately comes back up, stops us out, and you can see on the right hand side is that price ends up stopping us out, and then you can see price ends up gravitating all the way back down towards our original target. And this is one of the most frustrating parts about trading, is that we ended up having the right thesis, price ended up gravitating straight towards our target as well. But what happened? We end up losing money even though we were right. So as you can see on the next slide, what we have in this case is the opening range break and retest. So you guys have heard me talk about the setup plenty of times now. You should already know what the opening range break and retest is. When we mark out the first candle high, what we like to see is a retest continue push towards the upside. Right now we have our 5-minute opening range mark out. You can see price comes back down, taps it perfectly, and we continue back towards the upside. So you can see how well price action is respecting these key levels here. Whenever we do have an opening range break and retest and it's super clean with displacement, with other confluences as well, it's nice and easy because everyone can see it. Of course, this is in hindsight, but when price is respecting key levels and moving in a trend, this is the best time to trade the opening range break and retest. Now we actually have a break and retest towards the downside. We mark out the first 5 candles, price breaks below, we come back, retest, and we continue towards the downside. So you can see in this case, right, what we have here is nice clean break and retest setup that works right away. And this is exactly what we want to see every single time we trade. But the reality of trading is that trading is not always perfect. We wish that every single time it comes back towards our break and retest levels, we have clean entries, clean stop, clean targets, but it's not always like this. If it was this easy and happened every single day, then we would all have 100% win rates, and we would even need the 84% rule to begin with. It's not always going to set up either due to market conditions, either it has news, it could be choppy that day. Of course, we wish trading was like that, but it's not always like that. So what happens? Sometimes, as you can see right here, the trades just don't work out. They can be a textbook setup. You can have a nice 5-minute range breakout towards the downside, comes back up to retest. We have a nice reaction candle, stop just to break above, and then price continues lower, but then price just comes back up, stops us out, and then reverses back towards the upside. So sometimes we have the right thesis, we have the right setups, we have the right conditions, but some trades just ultimately don't work out. So if you're wrong, don't marry your trade. There's no reason to hold on to a losing position. We're going to accept our loss and we're going to be waiting patiently for the next trading opportunity. But there is one scenario that I want to talk about. And this one scenario is that, have you ever gotten stopped out of a trade by a few points only for it to head towards your original target? Sometimes what happens is you're right, but your timing is off. This can be due to sometimes premature entries. Maybe you're a little bit too aggressive. Maybe you have your levels marked off a little bit wrong. Maybe you're not waiting for the candle closures. Maybe you have your stop just a little bit off. Sometimes everything can be right, but your timing can just be a little bit off. So as you can see right here, what we have in this case is a 5-minute opening range break and retest once again. Price breaks towards the upside. We're coming back down. You can see we're having a little bit of reaction here. What are we going to do? We're going to enter in a position with our stop just to break below this candle low. We have a nice push towards the upside. We're looking for a 1 to 2, but then price comes back down, tags us, and then we end up stopping out. This was a great setup. We end up having this nice continuation towards high of day. We wanted to see continuation higher, but it ultimately comes back down and stops us out. But then it heads higher the rest of the day. And as I mentioned earlier, this is one of the most frustrating parts when it comes to trading, is that you had your correct thesis, you had your correct entries, you had your correct stop, you had your correct targets. But what happens? Somehow price ends up stopping you out, and then it just continues higher for the rest of the day. And now you're all upset. You're feeling FOMO because you end up missing out on a great opportunity. And now you're wondering, where can I get back in? But now it's too late and price is already way back at high day and we're continuing towards the upside. And this is where the 84% rule comes in. So the 84% rule states that if price stops you out on a trade and the same trade presents itself again, you can take the same original trade at a second time using the original stop and targets, and it'll work 84% of the time. So if you have a solid trade thesis with a solid setup and price stops you out and it sets back up means it reclaims the key level once again. What can we do is use the same original trade thesis, in this case the same stops, the same targets, and what can we expect now is the trade to work out 84% of the time. You can see this is a very powerful tool that we can use. So when we're looking for the 84% rule, there does not need to be a pattern on the second entry. What the second entry can be is a reclaim of a key level. Depending on the setup that you use, this can be the break and retest, this can be the opening range break, this can be your previous day high and low break and retest, this can be an order block break and retest. As long as it reclaims that key level, we can put on the exact same trade thesis as we did the original trade, and now we can expect it to work 84% of the time. So as you can see, it is a very powerful rule, and if the trade sets back up, it's going to work 84% of the time. So you can see how that would increase your win rate instantly when it comes to your trading. So as you can see right here, let's talk about the pros and cons when it comes to trading the 84% rule. So as you can see right here, what we have is our original trade thesis. We have our opening range marked out, price breaks towards the upside, come back to retest, right? We have an entry, stop's going to be a break below. You can see price breaks underneath, ends up stopping us out. So our entry here is our 227, our stop loss 225.5, ends up stopping us out. And what happens? Right? Let's say price wants to reset back up. As you can see right here, price is still holding market structure. We're still making higher lows in the overall market. When price sets back up, meaning price now gets above your opening candle range high with a strong candle closure, what can we do? We can look for a re-entry once candle closes above your opening candle range high on the 5-minute at your 227 with the exact same original stop as well, with the original targets that we previously had, which in this case is a 1 to 2 risk reward. So this might be a lot to kind of digest. As I mentioned, if the trade sets up once again, we can look for the exact same trade with the original entry, original stop, and the original targets. And in this case, the first trade, if we're looking for a fixed risk reward with a 1 to 2, what we would have in this case is the first trade would be negative $1,000, assuming that we would risk $1,000 for our multiple. And then our second trade, what we would gain is $2,000. So we would have a net gain of $1,000 versus negative $1,000 if we did not take the 84% rule. So as you can see, the difference between taking the 84% rule versus not taking the 84% rule is 2R, which is huge. If we take this over a year's worth of trades, this is going to increase substantially not only our win rate, but our profit as well, along with our R multiple. And this could be the difference between being a slightly profitable trader to being a very profitable trader, is by implementing this 84% rule. So let's go on to another example here. You can see on the left-hand side, what we have is the SPY chart. We're well underneath your previous day lows. We're dropping here in the pre-market as well. So in this case, we're bearish coming into market open. And coming into market open, what are the key levels that we're going to have marked out? We're going to have marked out in this case, your key pivot level, which is your 5-minute opening range. If I count it to 5 candles, this is your 5-minute opening range along with your up close candles in this case, which is your order block. So you can see price breaks underneath your 5-minute opening range, comes back up towards your 5-minute opening range retest. You can see we have a nice reaction off this level. This is where we enter in with our stop just a break above, right? We have our entry at this 523, stop loss 524. And what happens? Price ends up coming back up, right? Still holding eventually tags us out, as you can see right here. We end up getting stopped out here at this 524, but what happens? Price actually ends up getting back underneath this 523. And once price gets back underneath this 523, along with your 1 minute order block with your 5 minute opening range, we can look for what's called the 84% rule. So you can see right here, as I'm a little bit zoomed in here, price breaks back underneath your 5 minute opening range. This is where we can get in with a stop similar to before, right? Our original stop being that 524, our re-entry here is our 523, and our targets in this case, right? Fixed risk reward, which is a 1 to 2, and we end up having this nice push back towards the downside towards our original target, which was a 1 to 2, along with your pre-market lows here as well. So you can see our original trade thesis was correct. We're looking for more continuation down towards your pre-market lows because the 15-minute time frame was bearish coming to market open. We had a super solid entry being that 5 minute opening range, but what happens? We have a nice reaction. We manage this perfectly. We have our stop just to break above, but we end up getting stopped out, but price ends up getting back underneath the 5 minute opening range along with your 1 minute order block as well. And what we can do in this case, since we do have that 84% rule in our toolbox, we can now look for that re-entry with the exact same stops, with the exact same targets as before. And what can we expect? We can expect this trade to work out 84% of the time. So now we're looking back on this similar to before. If our risk to reward in this case was a 1 to 2, our R multiple was $1,000. That's our risk amount. So $1,000 we lose on the first trade. A second trade that we take is plus $2,000. So similar to before, right? Instead of losing $1,000 on the day, we're going to now be up $1,000, which is a 2R multiple swing. So this is a huge advantage when it comes to trading, not only trading, when it comes to scalping as well. And this is one of the most powerful scalping tools that you can use because, as I mentioned earlier, our thesis can be right and we can get stopped out by just a few ticks. But if the trade thesis is still set up, we can always look for a re-entry being that 84%. So now let's talk about some rules and my personal rules and how I trade the 84% rule. If you stop out on the first trade and the 84% rule sets up again, I will not look to take any off at high of day. So let's say, for example, right, the first trade, we end up having this nice break and retest. We look for an entry right here for this continued push back towards upside. But what happens is price ends up breaking underneath this level. Let's say we get stopped out, for example, and then price eventually sets back up, right? Our entry is right here. Our stop is the same as before. What am I going to be looking for now, right? On the first push, right, I potentially could be looking to take some off at high of day, maybe 25%, depending on the context and the overall strength of the market. But in this case, if price reclaims your key level, instead of looking for high of day, I'm going to look for my original target, which in this case would be an external level. This can be a previous day high. This can be a key level on the higher time frames. Instead of looking to take some off at high of day, I'm going to look to take some off at the next external level, being most likely a 1 to 2 risk reward and greater towards the upside. So whenever I take the first trade and I lose, I'm now going to be looking for that next external level. So my risk to reward makes sense. So if I was to lose a full R on the first trade, my second trade, I want a minimum 2R, just based off the fact that 84% of the time it's going to work out. So why would I not hold to my original target instead of selling at high of day, where if I sold some at high of day, my risk to reward might be 1.5 instead of 2, and it wouldn't make too much sense in the long term. And just based off math and statistics, I'm going to take those probabilities and look for that external level. Next, if you take the 84% rule without taking the first trade, you can take some off at high of day. So the 84% rule can be used without actually taking the first trade. Most people don't know this, but basically the 84% rule is a reclaim trade. There might be some circumstances where you don't like the context of the first trade. Maybe you can avoid the first trade depending if it's a choppy market. Maybe the confluences are right. Maybe the spine cues aren't looking the greatest. So there's a possibility that you can take the 84% rule without actually taking the original trade. And if that's the case, what you can do is actually look to scale some off at high of day if you would like. But as I mentioned, majority of the times it does hit your normal target. So majority of the times, if you do scale some at highs, you want to take a very small amount off. Next, what we have is the 84% rule is a reclaim of a key level once the candle closes. So what you have to understand is the 84% rule is a reclaim and not a retest. 90% of the 84% rules that I take is a reclaim trade. And the best reclaim trades occur when it does not come back down to retest. So for the 84% rule, what happens in this case, price gravitates towards the upside. We end up failing at this retest level, price comes back down, and then it sets back up. right? Once it sets back up, really you like to see price gravitate towards the upside in a very quick manner because price now does not need to come back down, come back, retest this key level, and then push back towards the upside. What you want to see is speed and momentum on this reclaim, and you like to see a very strong push towards the upside. So whenever price reclaims this key level with a strong candle closure, I'm expecting price to gravitate up and towards my original target and above in a very fast manner. And another rule that I have is do not use the 84% rule if you're not taking proper setups. If the first setup you're taking is not a break and retest, you don't have proper setups, you don't have proper criteria with a proper entry and exit plan, then what you're taking is not a good setup. And at the end of the day, taking a bad setup is still a bad setup. So if you look for the 84% rule on a bad setup, most likely that's going to be invalidated, and that's going to just indicate that you're trading chop. And most people, instead of thinking that they're taking the 84% rule, what they're going to do is just going to get chopped around because they're not taking a good setup to begin with. So first, you have to go back test this yourself. Make sure that you're taking proper setups to begin with and see how this 84% rule can affect your trading. With this being said, now let's go on to some examples to see exactly what this looks like on the charts. So you can see here, we're on my first example, we're on SPY, and you can see looking at its previous day's price action, we're well underneath its previous day lows here. In the pre-market, we're dropping towards the downside as well. So coming into market open, based off of yesterday's price action, we're leading more towards the downside just because we have a huge drop in the pre-market. So coming into market open, now what the key levels we can have marked out is going to be your pre-market lows. You can now also mark out your previous day lows. In this case, your previous day lows aren't going to be as useful just due to the fact that we have a big push towards the downside here in the pre-market. So we're going to use our pre-market levels along with intraday levels as well. Now let's go into lower time frames. So let's play the tape coming to market open. So right here, I have the first 5 minutes played out, and the key levels I'm going to mark out in this case is going to be your opening candle range high. I can also mark out your opening candle range low as well. What I like to see now here for the SPY is the hold underneath your 5-minute opening range, this 1-minute order block as well, for this continued push down in towards your pre-market lows, just based off of the higher time frames and your pre-market action as well. So now we'll wait for the retest of your 523. You can see so far, price is now coming back up in towards our 5-minute range. The sellers are stepping in here right off our 5-minute opening range, along with our 1-minute order block as well. This is where we can go look in short. We can short here with a stop just to break above. And now what we can be looking for is price to continue down in towards your low of day and below being that pre-market lows. Let's play out the tape now. And you can see right there, we would end up getting stopped out right at this key pivot high. That's exactly where our stop was. We end up getting tagged out of our position, but technically you can see the overall market is still staying heavy because we are creating these lower highs and price has not broken above your high of day level. So now what I'd be interested is the potential break back underneath your 5-minute opening range, along with your 1-minute order block as well, for this continued push all the way back down in towards your pre-market lows. Now let's play out the tape. So you can see right there, price closes back underneath this 522.50 level. This is where we can go look short with a stop loss just to break above our original key level. And in this case, what I'm going to look to target now is going to be your pre-market lows. I'm not going to be looking for a low of day because now what I'm looking for is this continued push down below your low of day and towards your pre-market lows. Just based off my probabilities, I'm going to be looking for that full take profit all the way down at this 515.89 key level. Now let's play out the tape. And you can see price right there ended up gravitating all the way down towards our 515.80 level, which was a super solid move right down. As soon as we broke back underneath your 5-minute opening range, along with your 1-minute order block, we end up having this super nice delivery towards the downside right after 10 o'clock as well. So you can see in this case, we would have ended up making $4,200 on the day. On the first trade, what happened is that we're negative $1,700. And on the second trade, we end up making over $6,000. So you can see the risk to reward. We're risking $1,700 to make over $6,000. We took the first trade and we lost, which was a minus $1,700. But we ended up taking the second trade, which was plus $6,000, which ended up giving a total of $4,200 on the day. So we end up making $4,200 on the day with the 84% rule. If we didn't have the 84% rule in our playbook, we would be down negative $1,700 on the day. So you can see the difference between using the 84% rule and not using the 84% rule. There's a big swing in your P&L along with your other statistics as well. Now let's go on to another example that I have. So you can see right here, we're currently on the Tesla chart, and looking at the past few sessions here on Tesla, I'm fairly neutral. We end up having this nice push towards the upside on this day. Second day, we had another continued push towards the upside. Day number 3, we just kind of reverted back into day number 1's range. So coming into day number 4, what I like to see is really the reaction that we have off of the key touches that we had on day number 1, 2, and number 3. So the key levels I could have marked out coming into this day would be this key level that we have marked out, which is our 274. So coming into market open, what I like to see is the reaction that we have off of your 274. If you can get above your 274, we can see this continue push back up in towards your previous day highs, which is going to be this 284. If you get back underneath your 274, then we can just see this push back down in towards your previous day low. So now let's go on to the lower time frames to see the price action that we have coming into market open. So you can see I have the price played out for the first 15 minutes here. You can see price immediate push towards the upside, and then we're finally getting now that break above. Now it's going to be your 5-minute opening range along with this 1-minute order block as well. So what I'd like to see here for Tesla is now the hold of this 1-minute order block. So now as long as we can maintain above this 5-minute opening range along with this 1-minute order block, I like to see this continue push back towards the upside to target where in this case it would be all the way back up and towards your previous day highs at your 284. So let's see the reaction that we have on Tesla around this key level. So you can see right here, Tesla, it's coming back into your 5-minute opening range along with your 1-minute order block as well. You can see some buyers stepping in off this key level. Not the strongest, but let's say right here, we get into Tesla. So we get into Tesla, our stop is just going to be a break underneath this key pivot point, and our target is going to be all the way up and towards your previous day highs. Of course, as I mentioned, this is fixed. So we're going to be taking partials along the ways, but our final target would be your previous day highs. Let's see how this trade would play out. And you can see right there, immediate stop out on Tesla. Price just came all the way back down. We ended up just getting wicked out, but you can see immediately right off the bat, Tesla actually sets back up once again. So our first entry was off our 5-minute opening range. We immediately stop out, but price is, as I mentioned, still holding our key levels. So we're still making higher lows here. So if price sets back up, which in this case, you can see right here, sets back up on this 950 candle. Now we can actually go back in once this candle closed. So we can get back in here on Tesla once this candle closes at this 950 or similar stop losses before, and we still have the same profit targets. Now this trade should work 84% of the time because we're now setting back up. We're still holding key levels. Now what I like to see is now Tesla hold this key level and push back towards the upside here on the overall markets. Now let's play out this tape. And you can see right there, Tesla ended up having this nice push back up and towards your previous day highs. And you can see we ended up making $5,400 on this day after reclaiming your key level being that 5-minute opening range along with your 1-minute order block. And you can see how well price action ended up respecting this key level. Once we got back above it the second time, you can see we end up holding this key level, which was your 276. We end up having this super strong push towards upside right in towards our previous day's highs. So you can see how well this 84% rule was used, and we end up being plus $5,400 instead of being negative $2,000 on the day. So you can see, as I mentioned, how powerful this 84% rule is. Our thesis was correct, but our timing was just a little bit off, and that's okay because sometimes when you get into a trade, it's not always going to work right off the bat, and that's why we have these 84% rules in place so we can capture these type of moves. Now let's go on to my last example that I have for us today. So right here, you can see we're on Tesla once again. I'm fairly neutral coming to this day. I'm leaning a little bit more towards the downside because we're underneath day number 2's low. If we're looking at this, we're dropping here in the pre-market. We're also just around your day number 1 lows as well. So if you can get underneath your day number 1's lows, you can see this continue push back down towards your pre-market lows and below. So coming into today, the key levels I'm going to have marked out is going to be your day number 1's lows, which is your 251.27. I'm also going to mark out your previous day lows as well, which is going to be your 261. 251.60. And now let's go into lower time frames to play out the tape. All right, so coming into market open now, what I'll be looking for is the reaction that we have off of these key levels. If we can get underneath your 251.27, I'll be very much interested in this continued push down towards your pre-market lows and below. So let's see the price action that we have coming into market open. So you can see right off the bat, price pushed towards your previous day low, not quite hit your previous day lows, but now we're pushing back towards the downside. Now we're underneath your day one's low. So what I like to see is really the hold underneath your day one's lows for this continued push towards the downside. So right here, you can see that Tesla has that break towards the downside. We're now coming back to retest this 251.27. We also have this 1 minute order block here as well. So this is where we can go look short with a stop loss just to break above this key level. And in this case, our targets can be all the way down towards your pre-market lows and below here on Tesla. And we can drag this towards the downside. Now let's play out the tape. So as you can see right here on Tesla, we end up getting stopped out. We're still right around this 1 minute order block, which also coincides with this 251.38. So if price still can get back underneath your retest level, we'll be looking for this continued push back towards the downside. Let's keep playing out the tape here. So you can see right here, price is now pushing back towards the downside, back underneath this 251.38. What I like to see now is it just hold underneath this 251.38 for this continued push towards the downside. You can see super nice reaction now once we got back underneath. This is exactly where I went in short with a stop just to break above. And now I'm looking for this continued push back down towards your pre-market lows here and below. Now we can play out the tape. And as you can see, we end up having this nice push towards the downside. I was actually able to avoid the first trade based off of confluences and other things as well. Obviously, you guys can't see the confluences currently with the QQQs because I don't have this pulled up, but there's other confluences along with other things as well. But strictly basing it off of the underlying, right? Even if you did take the first trade, you can always look for the re-entry of the second trade for this continued push towards the downside. I'm also going to pop up my executions and screenshots just so you guys know that I did take this trade in real time. Now, with this being said, let's go on to the live session to see exactly what my thought process was, why I actually ended up not taking the first trade, but instead took that second trade for this push down towards your pre-market lows and below. Past few days, Tesla kind of lagging behind. So we'll keep an eye on Tesla off of this 252 coming to market open. If you can get underneath your 252, we'd be looking for this continuation lower down potentially towards your Monday's lows. So coming into today, what we have here is your Wednesday's lows. If you can get underneath your Wednesday's lows being that 252, we can see this push down in towards your pre-market lows and below being that Monday's lows on the higher time frames. So this is basically your Monday's lows right here on Tesla. What I like to see is it just basically stay heavy now with the Qs. If you can stay heavy underneath basically your 252, I like to see some sort of pushback towards the downside here on this name. We'll also have an up close candle here at this 938, so that'll be where I'll be looking for a potential entry point here on Tesla. All right, so with this fine Qs, you'll just want to see these up close candles be respected for this push lower. You see Tesla's actually showing a little bit of relative weakness here as well. Tesla does look good for a push down in towards that Monday's low now, which is that 243. The key levels I'm looking for is basically this 251. So this 251, which is your Wednesday's low for continuation down in towards your pre-market lows and your Monday's lows. Or a little bit of a bigger reaction here, but it's just coming right back into these up close candles. Now you just want to see the reaction, and Tesla's coming back up as well. So let's keep an eye on Tesla here. What I would be looking for, yeah, I'm looking at the 250s on Tesla. So you do have a little bit of reaction here. I don't like the context as much with the Qs. Tesla, if this can stay heavy underneath 252, then I'll be more interested. Nvidia would have to stay heavy underneath this 97. So right here, as you can see, I'm interested in Tesla off of your 252. I'd like to see a little bit more weakness, which is going to be this 3-bar confirmation towards the downside. The context, as I mentioned, don't like it as much with the Qs. Qs would have to reject off of your 1 minute opening range, which in this case, you can see it's kind of pushing back towards the upside. So for Tesla, I am interested, but I'm going to wait for a little bit more confirmation just because of the context, as you can see, based off the QQQ right here. So for Tesla, I'm actually like, this looks to me like a 5-minute setup. If we're gonna be looking for Tesla, right, 5-minute setup off of your Wednesday's lows for this push, you can see a couple wicks up here, and your risk would be above that like 250 candle, especially on this candle right here. So yeah, as you can see right there, we're being a little bit patient here on Tesla. I just mentioned this looks a lot better on a 5-minute setup. So right there, it was just 10 o'clock as well. As you know, 10 o'clock usually has an injection of volatility. So that's when the markets start to have a bigger move. So now for Tesla, very much interested. 5-minute looks really good. Now what I like to see, hold underneath this 252 for continuation lower. If we're looking at the SPY here, basically rejecting off of your 1 minute opening range, getting back underneath, I like to see this continue push back towards the downside here on SPY as well. If you're looking for Tesla, this is what the Tesla trade would look like. Basically a risk just to break above, like super tight risk. Off for 250, now you like to see it gravitate lower. All right, keep an eye on Tesla.
All right, I just got in some of the 250s. Risk was super tight. This one has to work right away.
So as you can see right there, I just hopped into some of the 250 puts on Tesla. You can see super nice reaction so far off of your 251 once you got back underneath. Context for me looks a lot better here now with SPY rejected after a 1 minute opening range plus 10 o'clock as well. The fact that Tesla is staying heavy on the 5 minute time frame, I'm expecting now continuation towards the downside. And you can see where my target is in this case, which is all the way down in towards that Monday's lows.
All right, scale, hey, low of day, scale base. This one, if you can get underneath, this one looks really good, potentially towards your pre-market lows, your Monday's lows.
So you can see right there on Tesla, I was taking some off as it was heading towards the downside. In this case, for my rules, as I mentioned earlier, if I did not take the first trade and I take the second trade, I'm going to look to take some off, just a little bit of amount, right? 25% to potentially 50%. If I took the first trade and I took the second trade, then I would not scale any off at low of day, and I would be looking for that push all the way down in towards that Monday's lows. Yeah, you can see Tesla, nice push down in towards that 246. You can see SPY, nice push down towards the downside as well. So now what I like to see up close candles be used as resistance for this continued push towards the downside here on Tesla.
Contracts up 100% now, 241. Q shopping heading towards this pre-market lows here. SPY similar as well.
And yeah, you can see for Tesla, as we kind of speed up the tape here, perfect retest off SPY off of your low of day for this nice continued push towards the downside. Tesla end up holding your up close candles. Very nice push all the way back down in towards that Monday's lows. End up being a super solid trade right in towards that key level that I talked about, as you can see right here. End up being a super solid win on the day. And that's exactly how you can use that 84% rule. In this case, I end up taking the 84% rule without taking the first trade. But either way, regardless, if you take the first trade or if you don't take the first trade, the 84% rule is a very powerful tool that you can use in your trading to increase your win rate and to level up your trading right away. With that being said, I hope you guys enjoyed that video. If you did, I'd appreciate if you guys drop me a like and sub, and I'll see you guys next week for a brand new video. Peace.